So obviously you keep talking about this eye-opening figure that, it's the second largest line item in the P&L, the trade promotions management number. Um, what are the real costs and what are the hidden costs of this problem that you keep uncovering?
So there is an element of retailer abuse or distributor abuse. There are certain distributors out there who will ding you very, very hard if they you're not checking deductions and pushing back on a constant basis. There is an element of sales team abuse as well. If you do not have a very coherent planning process and promotion documentation process, you could have a situation where a salesperson, to meet his target, may go out to a retailer and offer promotions which are unauthorized, offering more promotions than is allowed by the management, or offering even very much deeper promotions which may never be approved by the management if they were to know of it. And the salesperson is able to get the sales, because don't forget that the deductions trickle in 1, 2, 3, 4, even up to 9 months later. You could also have post audits up to 2 years later of anything that you would sell today. So it can lead to a sales team abusing the process, a retailer abusing the process. Then you could have your logistics partner not following the best practice and delivering product on time. And then as a result of that, you could have deductions hitting your books. And without challenging your logistics partner and without monitoring them, they would become your costs. And these costs basically add up very, very quickly. They could go into hundreds of thousands.
These are fundamental costs to the business, or hidden costs, by not having a clear grasp on the TPM process and the data. These are real costs that are going to affect the bottom line. This is cash out the door problems.
Absolutely.
Regardless of the motivation or the failings or whoever's caused, this is cash out the door.
Yeah. So say, for example, for a $70 million revenue company, if they are managing a TPM process well, they're about to get able to get $300,000 to $500,000 back, either by avoiding deductions that would have come in, or by pushing back on deductions that actually came in and they found to be unauthorized. Now, this cost directly goes to the bottom line. There is no cost of sales associated with it. It directly goes to your bottom line. And this is just an average I'm mentioning. You could have larger unauthorized deductions if you're not monitoring it properly. They could be coming in. You could even have very small amount of deductions, right? I'll give you an example. Walmart asks you to invoice in a certain way. If you generate your invoice that does not meet Walmart standards, they're going to ding you with a very small amount of deductions, about say $25 an invoice, right? It adds up very quickly. So if nobody is looking at it, $25 will keep on coming in. They will just keep on adding up, and over year to year, 3 years, they will really add up to something material. But if you have a team that is looking at all of these deductions coming in, and they're able to see that, hey, why are we getting this $25 for every invoice from Walmart? And they're able to go and fix their billing, which is relatively straightforward to fix billing so that it comes in the format that Walmart wants to look at. You're going to save that money. So you need to have the team who's looking into all the details and the nuances, starting from the planning portion all the way to deductions clearing, and the most important, the reporting portion. I always gauge it that is the company able to run a customer P&L? A customer P&L is very important, and I would think that very few companies are able to run it. But a customer P&L, what it does is that from gross sales to net sales, the company is able to assign every dollar of sales that they make and every deduction that comes in, all the way to net sales, to individual customers. And then they're able to see customer profitability. So this is one very important metrics that I look at, that is the company able to do that? And if my clients are not able to do that, even if they don't have a TPM system, I use my own team to help them get there over a period of time. Very, very important, because you need to know the profitability by customer. If you don't know that, there is a serious lacking. And And then, of course, the management is always looking for trade promotions optimization. Are you making money on the promotions? Are the promotions effective?
Okay, so that's great. And so we've got like the cash out the door costs. We've also got the write off cost. If someone actually goes back and makes a book adjustment, a book write off, that's never an easy thing to do. And I know it's not a cash cost necessarily, but actually have to go back and restate last year's numbers. That's I guess a paper cost that no one wants to have to face or discuss.
Yeah. Some companies, unfortunately, have to go and restate costs. Some companies who do not do the restatement, if they're not properly accrued at the year end, the following year, when the previous year's costs come in, their P&Ls get dinged very hard because they created their budget for the current year. They didn't anticipate a whole bunch of costs coming in from the previous year, and it basically destroys their P&L. So it is very, very important that the accrual is calculated properly. And this is the key role of the commercial finance and the accounting team. They have the initial plans approved by the management team, and then have those plans baked into their budgeting process. And then they are on a monthly basis are able to accrue the right amounts so that that particular month's cost is captured within the P&L of that month. And so in the future, like I said, that the deductions keep on trickling in 9 months later, in even 2 years later, all that cost goes to that particular month when the product was sold. And all the cost was captured in each month. And so that process needs to be solidified in the company for the company to be able to successfully manage this process. And if you have this process solidified, then you never have an accrual problem where you're taking the expense of the previous year in the current year because you didn't accrue enough. It's just understanding the whole concept, how the different pieces come together, how the process goes cross-functionally from one area to another, and everybody playing their part, so that the whole process comes together, including the accrual piece.
But if you're mounting up this problem, I'm guessing the auditors must be able to charge even more for their work if they're hitting this problem they have to analyze every year. Does that mount up as well?
Yep, this is a very important and good point. I've seen in more than one company, and I'm talking about really, again, Fortune 100 companies, where this trade promotions management, for lack of a better word, exploded because the auditors pointed out at the end of the year that your accrual was not enough. And I can tell you that even having dealt with the auditors, whether it is big four or mid-sized firms, they also don't know enough about this process. And it is very hard to know if you're not involved in the day-to-day of the business. So I don't blame them. But the auditors are able to figure it out ultimately, because when the accrual falls really low, they are able to then conclude that it is not enough. And when they start doing reverse calculations, they find that there is a hole for a good mid-sized company. I'm talking about $500 to $800 million. They can find holes of up to, say, $20 million, which then throws the whole management team in a tizzy, in a tailspin, when the auditors come up with it. Because the worst thing you want to happen is that the auditor points it out, which then means that the management team missed it.
Yeah, no, I get, and also there's kind of the knock-on impact of your relationship with your bankers or your investors, or if you're trying to sell or you're about to buy, there's that impact. But there's also kind of the personal impact. If you're running a finance function, if you're the CFO or the controller, and this is blowing up under your watch, then the personal risk and the personal damage or personal cost seems pretty huge without,
You're absolutely right. And because it's a cross-functional process, and without management understanding and oversight, the individual function would know that there is something wrong, but because of the daily priorities, it may be not at the top of the priority. So yes, when it blows up, when the companies realize that there is a problem, by that time it's a bit too late, and then there is a lot of individual effort involved and to fix it, and of course, like you said, that it brings grief to a lot of good employees. It may or may not be their fault, or they may just be unaware as to how the process should have been run. So yeah, I mean, if companies do not have a robust TPM process, I would advise them not to wait and look out for an expert who can give them the overall picture as to how it works, and then identify the weaknesses.
It's interesting because when the problem blows up, there's multiple departments involved. There's obviously sales, there's technology, there's promotions, there's finance, but it's always finance that gets the blame.
Yes, and the finance gets the blame because the ERP system or the books of account, as you call it, is the holy grail or the Bible. Irrespective of what is happening in the organization, the numbers are the responsibility of the accounting or finance department. So yes, they are the first one who take the hit because they are managing the auditors. They have to answer all the questions. So they take the hit first. They are the first ones to be thrown under the bus. So that is absolutely true.